Alright, breaking news everyone. The gold price just shattered another milestone. It just surged past $3,500 per ounce in the US, setting yet another fresh record. Now, let's break it down. So, what's driving this rally? And is it still worth buying? Let's find out. If you're new here, welcome to my channel where we explain the news in finance in plain English. So let's get right into it. Okay, first things first. Here's our latest flash report as of today, October 4th, 2025. Gold is currently trading around $3,586 per ounce, which is astonishing. That's about a 34 to 38% climb since the start of 2025, making it one of the strongest yearly performances on record. On September 2nd, gold hit a new high of $3,526 per ounce, surpassing its previous all-time highs from earlier this year of $3,492 set back in March. Analysts forecast that gold could climb another 10% this year, reaching $3,930 by mid-2026. In a worst-case scenario, gold could hit $5,000 or more if political uncertainty around the Fed spikes. Now, some may say that's too rich for blood. I mean, does anyone actually believe that gold is actually worth $3,500 per ounce? But others say that's nonsense. They believe that the current price of gold is justified given the economic conditions and uncertainties we face. Now, you might be wondering, should I buy gold? Is it too late? First, let's talk about what's driving this rally. There are three major factors. No. 1. Expectations for the Fed to cut interest rates soon. Number 2. Rising demand from central banks around the world who want to diversify their reserves away from the dollar. And third, heightened geopolitical uncertainty and persistent inflation worries. So let's dive deeper into each of these points, starting with factor no. 1. Interest rates. Last Friday, U.S. jobs data came in weaker than expected. Factor no. 2. Global central bank demand. For decades, many central banks have been shifting away from holding vast amounts of U.S. treasuries and instead diversifying their reserves with gold. Why, you might ask? Well, gold has been seen as a safer investment than stocks or bonds because its price doesn't depend on economic growth or government policies. It also acts as an insurance against currency fluctuations and extreme inflation. You see, in times of economic crisis, having a significant portion of your reserves in gold can be a safety net. Recently, countries like India, China, Turkey, and Poland have been steadily increasing their gold reserves. For instance, India's central bank has added the most gold in almost 2 decades. So far this year, they've purchased 113 tons of gold. China, the biggest gold beer in the world, has bought nearly 60 tons this year, and Turkey has increased its holdings by 29 tons. Together, central banks around the world have added a net 341 tons of gold in the first half of 2025. That is the highest level in over 50 years. At the same time, they've been selling off billions of dollars in U.S. treasuries. These central banks now hold roughly 20% of their official reserves in gold. This trend is a stark contrast to the early 1990s when many central banks, including the Fed, actively sold gold. By the way, the world's total gold reserves amount to about 35,000 tons, which is worth roughly $200 billion at current prices. And factor no. 3. Geopolitical uncertainty and inflation. The Russia-Ukraine conflict, tensions in the Middle East, and other geopolitical events have made investors extremely nervous. Many are turning to gold as a way to protect their wealth during these uncertain times. You see, gold has long been considered a safe haven asset. During conflicts, gold prices often rise because it's seen as a way to preserve wealth and protect against risks. In addition, recent supply chain disruptions and conflicts have contributed to a steady increase in inflation. That's made investors even more interested in gold as a way to hedge against inflation. So those are the three main factors driving the price of gold higher. Now let's take a look at the technical levels to watch. Now let's talk about what you should do as an investor. Here are some takeaways. First, gold is still a good hedge against inflation and uncertainty. However, don't chase the peaks. Buying gold in a systematic way through ETFs or physical gold can be beneficial. For example, consider ETFs like GDX or gold futures. Then use dollar cost averaging to make regular purchases regardless of the price. That way, you can buy more shares when prices are lower and fewer when prices are higher. Second, watch the dollar, Fed policy, and geopolitical headlines. If the dollar weakens or the Fed signals rate cuts, gold usually rallies. Similarly, if geopolitical tensions escalate, gold tends to rise, so stay updated on these developments. Lastly, remember that gold has its own cycles and it's normal for prices to fluctuate. Don't panic sell unless your financial situation changes. And keep in mind that holding gold alongside other assets in your portfolio can help reduce risk and enhance returns. So there you have it. Gold is currently trading around $3,586 per ounce, marking a strong yearly performance of 34 to 38%. Factors like Fed rate cuts, central bank demand, and geopolitical uncertainty are driving the rally. While gold remains a good hedge against inflation and uncertainty, consider dollar cost averaging and stay updated on global economic and political events. Don't forget to subscribe and join our community to stay informed. Thank you for watching. Until next time.